Think you're paying too much in taxes? You're right. You probably are, and I'm about to show you exactly how to pay less. The IRS takes more than they need to, and today, I'm breaking down how to keep your money where it belongs, in your pocket. Stick around because the last strategy I'll show you is one most people miss, but it could save you thousands. First things first. Did you know you can pay zero in taxes on your investments? That's right, zero. Let me explain. If you've been holding on to stocks, bonds, or even cryptocurrency for more than a year, and you're under a specific income threshold, you don't have to pay a single penny in federal taxes when you sell them. And no, this isn't a loophole just for the rich. It's for anyone who qualifies. If you're single and making less than $60,000, or married filing jointly and making under $120,000, you could be eligible for the 0% capital gains tax rate. That means you could sell your investments and pay nothing in federal taxes on your gains. Now, imagine you make $55,000 a year. You sell some stock you've held for more than a year, and it nets you $10,000. Under the 0% tax rule, you pay nothing on that $10,000. This is real, and most people don't even know about it. And here's where you need to pay attention. Even if you don't qualify right now, it's about timing. If you have a year where your income dips, maybe you worked less, had fewer commissions, or your freelance gigs slowed down, this is your chance to sell those long-term investments and pay zero taxes. But what if you're making more than $60,000? Don't click away yet, because there's still a way to cut your taxes, and it's called tax loss harvesting. This strategy is all about turning your investment losses into wins. Let's say you've made some gains on your investments, but you also have a few losers in your portfolio. By selling off the losing investments, you can offset the gains and reduce your taxable income. So if you've got $20,000 in gains, but a $10,000 loss on another investment, selling that loser means you'll only get taxed on the remaining $10,000. That's a major cut to your tax bill, and it's completely legal. And here's a tip most people don't know. If your losses exceed your gains, you can deduct up to $3,000 from your other income, like wages or business earnings. That means if you lose more than you gained, you still come out ahead because it reduces your taxable income. Got a $9,000 loss this year? Deduct $3,000 now, and carry the remaining $6,000 forward to future years. This strategy can work over time to save you even more money. Oh, and before you go sell everything, watch out for the wash sale rule. If you sell an investment at a loss and then buy it back within 30 days, the IRS won't let you claim that loss on your taxes. So, be smart. Either wait 31 days before buying it again, or consider switching to a similar, but not identical investment to avoid the penalty. Alright, pause for a sec. If this is already saving you money, hit the subscribe button so you don't miss out on more ways to legally keep more of your money. Now back to another strategy that could seriously change your retirement planning: Roth conversions. Roth IRAs and Roth 401ks are game changers because once your money is in a Roth, it grows tax-free. And when you take it out in retirement, no taxes. Zero. But here's the thing, moving money from a traditional IRA or 401k into a Roth means you have to pay taxes on the amount you convert. So why would you do it? If you're in a lower tax bracket now than you expect to be in the future, converting to a Roth can save you thousands of dollars later. Here's how it works. Let's say you have $50,000 sitting in a traditional IRA, and you decide to convert $20,000 to a Roth this year. If you're in the 12% tax bracket, you'll owe $2,400 in taxes on that $20,000. But here's the beauty of it. Once that money is in the Roth, it can grow for decades without being taxed. By the time you retire, that $20,000 could easily grow into $100,000 or more, and you won't owe a single penny on the gains. And remember, this is only taxed when you convert it, so if you're in a lower tax bracket this year, lock in those lower rates before they rise. Let's shift gears to charitable giving, because yes, donating to charity can actually put more money back in your pocket. Instead of donating cash, you should consider donating appreciated assets like stocks or real estate. Why? You avoid paying capital gains taxes on the appreciation, and you still get to deduct the full market value of the asset. So, say you've got a stock that's doubled in value. If you were to sell it, you'd be hit with capital gains taxes. But if you donate it, you get to write off the full value and you avoid the taxes entirely. Another trick is using a donor-advised fund. This lets you make a donation, get the tax deduction immediately, but wait to decide which charities will receive the money. It's like a holding tank for charitable giving, and it gives you the flexibility to plan when and how you want to donate while still getting the deduction up front. And if you're over 71 too, you can make a qualified charitable distribution, QCD, directly from your IRA to a charity. The money won't count as income, and it satisfies your required minimum distribution at the same time. Double benefit, right? Did you know that if you're self-employed or running a small business, there's a treasure chest of tax deductions waiting for you? Most people miss these, but they can save you big money come tax season. And if you're serious about keeping more of your hard-earned cash, stick around because I'll give you a glimpse of the key strategies. Plus, we've got a full self-employed business and tax video coming up soon that you won't want to miss. First, the home office deduction is a game changer. If you work from home and use a part of your home exclusively for business, you can write off a portion of your rent or mortgage, utilities, and more. It's a massive win for anyone working remotely, but the IRS is strict. You've got to use that space solely for business. Next, if you're paying for your own health insurance, guess what? You can deduct 100% of your premiums. And if you have a high deductible plan, consider an HSA, health savings account. Triple tax benefits, tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. It's one of the smartest financial tools out there. Let's talk cars. If you use your vehicle for business, you can either deduct the standard mileage rate of 65.5 cents per mile or go the actual expense route. Think gas, repairs, and insurance. Either way, you can cut down your taxable income significantly, especially if you drive a lot for work. And here's a big one: retirement contributions. If you're self-employed, options like SEP IRAs or solo 401ks allow you to stash away a ton for retirement while slashing your taxable income, contributing up to 25% of your earnings or a maximum of $66,000. That's a huge tax advantage. Before we wrap up, let's not forget about business meals. You can deduct 50% of qualifying business meals, so if you're meeting a client, keep those receipts. And for your office, 100% of supplies and equipment are deductible, whether you're buying new computers or upgrading software. That's just a taste of what you can do to legally lower your taxes. And when you combine these with strategies we've talked about before, like maximizing deductions and using tax loss harvesting, you're looking at serious savings. The goal? Get as close to zero taxes as possible, legally. Stay tuned because we're diving deep into self-employed tax strategies in an upcoming video, where we'll show you how to really make the most of your business deductions. That wraps it up. Now make sure you hit subscribe so you don't miss that upcoming self-employed tax breakdown. And if you want more tips on keeping more of your money from the IRS, drop a like and let me know in the comments.